Welcome back to the channel, everyone. Today I want to talk about how Citadel Securities is facing margin calls. As tweeted by Nazim, Citadel Securities is said to be among firms facing a potential default on Russia's Yandex. Karma is a female dog. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, in this article posted by Bloomberg, it states that Citadel, DE Shaw and Sculptor are among bondholders in Russia's Yandex. Citadel, DE Shaw and Sculptor Capital Management are among investors facing a potential default on convertible bonds from Russia's Yandex. The Russian tech company's US shares have been suspended for more than 5 days, enabling bondholders to ask for repayment in full. The firm has already said it does not have the money to redeem the $1.25 billion worth of bonds, which are meant to be exchanged for common stock. Yandex is now in discussions over a potential restructuring with a group representing about 90% of bondholders. That basically means that Yandex can only afford to pay out 10% of those bonds and the other 90% needs to be restructured. The search engine Yandex has struck joint ventures with Uber, invested in startups purchased by Meta or Facebook, and offered food delivery services in London. But now, firms are cutting ties given sanctions against Russia following its invasion of Ukraine. Therefore, not only does Yandex not have enough money to pay off these bonds that are held largely by Citadel, but also a number of these bonds are going to end up becoming worthless because all of these firms are cutting ties with Yandex. On top of this, I think it's very important to remember that because Yandex has been suspended for more than 5 days, they've technically defaulted on this bond, and the bondholders can request full payment in US dollars. But because of the suspensions, Yandex can't pay any of this money even if they had a singular penny because of the suspensions. And that's just another reason as to why these bonds are absolutely worthless, and Citadel could end up entering default as a result. If Citadel ends up being margin called on these Russian bonds, then it could potentially end up margin calling their entire portfolio. If this one individual margin call on Russia's Yandex impacts their entire portfolio and causes them not to meet those margin thresholds and those margin requirements, then their entire portfolio could fall into default. If in the event that their entire portfolio does fall into default, they'll have to sell off all of their long positions and cover all of their shorts. This liquidation and winding down of Citadel will be performed by a third-party firm of accountants who will likely audit the firm while they're winding the company down. Therefore, not only will their legit short positions have to be covered, but also their synthetic shorts will be covered as well. To fully and properly wind down the firm, all of the creditors and all of the debtors need to be settled. Therefore, all of the legit and the synthetic shorts have to be covered, while all the long positions are sold off as well. And obviously, if Citadel are forced to cover not only their legit shorts but also their synthetic shorts, it will likely cause the AMC and GameStop squeeze, causing all of the other short hedge funds to be margin called as well. And on top of that, Unusual Whales has said that Russia as a whole could default on its debt as soon as Wednesday. The Russian finance minister says that payments on forex denominated bonds to countries that have sanctioned Russia will be in rubles, which isn't stipulated in the contracts. Donahue George says Russia will probably go into default on Wednesday. They have a $117 million payment which is due. Russia debt has been downgraded to C, which means default is imminent. It's likely this Russian debt will be downgraded further to D for default. And Donahue George asks, will this initiate a global market collapse? And will this cause margin calls and liquidations? CNBC posted the article that says as Russia nears a debt default, talk now turns to global contagion. And therefore, not only is this likely to impact Citadel as a firm and likely to cause a Citadel default, but could also impact the wider market. The IMF managing director on Sunday said that the Russian sovereign debt default is no longer an improbable event. It looks like Ryan Cohen is well aware of Citadel's current position, as Ryan Cohen has now started tweeting openly about short sellers. Guys, if you didn't already know, Moomoo and Futu have just officially announced that Futu does not accept payment for order flow, and therefore you don't have to worry about your trades going through sketchy dark pools or being given to Citadel. Right now you can currently get up to 5 free shares valued up to $3,500 each. That's a total of up to $17,500 in free shares just for signing up with Moomoo using the link in the description below and making your first deposit. Moomoo is also a brilliant commission-free trading platform that has tons tons of technical indicators and advanced charting tools. Moomoo publishes daily short selling data, position cost distribution, and much more. The Moomoo platform is also incredibly easy to use and will help you to trade like a pro. So guys, be sure to sign up to Moomoo using the link in the description below and make your first deposit. Ryan Cohen's previous tweet was about short sellers being the dumb stormtroopers of the investing galaxy, and today he tweeted saying a good use of taxpayer dollars is the government cracking down on hedge fund short sellers. Clearly, Ryan Cohen is well aware of the manipulation and the corruption in hedge fund short sellers, and now, based on Citadel's current position as they're just about to enter default, he's not afraid to talk about it publicly. As Duck said on Reddit, the man who hasn't telegraphed a single step of his overhaul of GameStop, being obviously Ryan Cohen, is now openly tweeting about one of the hottest topics surrounding his company. Duck says as his personal opinion, whatever Ryan Cohen's plan is, it's done and it's ready to execute. And there's also another very interesting take from Grungomp. He said, I hadn't seen this take yet, so I wanted to test the waters. He said Ryan Cohen has been actively cooperating in an investigation into the manipulation of GameStop via shorting for a year now, and so has Adam Aaron with AMC. He said he has the best possible inside view as to whether or not our tax money is being well spent. And so there's three possible realities as to what this tweet really means. The first is that Ryan Cohen is being intentionally sarcastic and means the opposite of what his tweet reads. He's calling out the government for its ineptness and is trying to tell us that they are misusing our money. But sarcasm is also terribly difficult to communicate through text, and I don't think Ryan Cohen would try something in that vein. He's too smart to not think of that in advance. There's significantly more effective ways to communicate that idea, so if not that, then what else? He says he could be trying to state that he has seen the government could be more effective if they were better funded, and that change needs to happen to get them the money that they really need to be effective and to take these investigations seriously. And that leaves us with a third take, which is to take it for face value, that those tax dollars are right now being used to actually investigate short sellers, and those tax dollars are actually being well spent and put to good use. He stated over and over that you should judge the SEC or judge everyone in general by their results, not necessarily by their promises. So if he is claiming that tax dollars are being well used to investigate those short sellers, then Grungomp has to believe that he's saying he's seen our tax dollars being actually effectively used. I, for one, am absolutely ready to see Citadel enter default and end up being margin called. I personally think these hedge funds are very scared of Citadel's imminent default because AMC has been trading perfectly in this channel for a very long period of time. Obviously back in 2020, AMC was trading below this channel due to all the aggressive naked shorting. In January, obviously the shorts lost control of AMC as AMC burst through the channel and out of the other side. Through the period of February into late May, the hedgies absolutely had AMC back under control as it was trading well within this channel again. Obviously back in June, the hedgies once again lost control as AMC went flying through this channel all the way up to $72 per share. Over the first 5 or 6 months after June, the hedgies really battled to get AMC down back into this channel. But obviously through January into March, AMC has been ping-ponging within this channel between $14 to around $22 per share. I think when AMC breaks through this channel at $22, $23 per share, the hedgies will once again lose control of AMC and the apes will be back in control. I think if Citadel ends up defaulting on Russia's Yandex, their entire portfolio could end up being margin called, which would absolutely cause AMC to burst through this channel. I also wanted to quickly touch on the brilliant Q1 box office results. So far, the 2022 Q1 box office has tipped over $1.1 billion, not even including the remainder of March. We could potentially be heading for a $1.2 or even $1.3 billion quarter. Now that is obviously significantly better than what we saw in Q1 and is fairly narrowly behind what we saw in 2020 pre-pandemic. And actually, if we look on an average per film basis, we're right up there with some of the bigger years like 2016 and 2017 with $10.3 million per film release. Now, the only thing that needs to be improved going forward is the number of films being released. So far this quarter, 107 films have been released, which is still nowhere close to the 302 and 321 films released in 2018 and 2019. On a per film basis, we are absolutely smashing it it, the industry needs to just work on creating more films like we used to back in 2018 and 2019 pre-pandemic. And I think it's very, very important to note that even though the S&P 500 had a green day today, we have not yet seen the bottom for the S&P 500. Hoz says, I can't say if the market has bottomed yet, but so far there has been zero capitulation. All previous big corrections had that capitulation volume. If we look at that 2020 pandemic crash, we saw a massive, massive spike in volume as traders capitulated and sold all of their shares. Again, when we saw the market downturning in 2018, again we had this giant amount of capitulation volume as everybody started to sell. But obviously so far in 2022, as the market has been trending downwards, we have not yet seen that massive, massive influx of volume of all of those hedge funds selling off their shares. And therefore the market is still very much in a current downtrend and will likely continue to fall until those hedge funds end up selling. Guys, be sure to let me know down in the comments below what you think about Citadel facing those margin calls. And as always guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.